Good afternoon, everybody, and thanks so much for joining us for today's monthly market update webinar. My name is Marianne Hensley. I'm the Vice President of Media Operations here at FreightWaves, and I am excited to be here with a couple of market experts here. I have Anthony Smith, who is our economist, and I have our very own Sultan of Sonar, Mr. Zach Strickland, who will be filling in for Craig today. A couple of quick housekeeping items before we get started. If you have any tech issues, throughout the webinar, you can reach out to us through that chat button in your control panel. And also, if you have questions that you would like to ask Anthony and Zach at the end of their presentation, you can submit those through the Q&A button. At this point, I'd like to go ahead and welcome Anthony and Zach. Welcome, guys.
Hello, thanks for having us.
Yeah. Hello.
Why don't you take a second and tell us a little bit about yourselves?
Go ahead, Anthony.
Well, I believe this is my fourth or fifth time here now on this webinar. I am the economist here at FreightWaves. As you mentioned, I have my background in economic consulting for a variety of industries. I've worked in industrial manufacturing segments, also a little bit on the consumer and retail side of things, and of course, in housing construction. Always looking at housing starts. And most recently here at FreightWaves to really kind of look at the macroeconomic outlook and the trends and how they affect the freight industry.
Yeah. So is my mic working?
Yeah.
Okay.
You're good.
All right. I can't hear myself very well, but so yes, I've bounced around the freight industry for 15 or so years. The main part of my life I spent in pricing and LTL, but I bounced around through all the departments, making, basically translating data into actionable information, as well as working with a lot of executive teams and operation teams to come up with, where the most relevant tactical information lies and how to use it. So, I was a financial analyst, pricing analyst, as well as a data engineer for a little while. So now I'm at FreightWaves as the Sultan of Sonar, basically because I know all about data. So yeah, let's kick it off. So Anthony, you're up first here, right?
Yeah. I think I'm up first, but I think for those of you that are just now joining, just a real quick background about who we are at FreightWaves. We are building as it says here, a world-class community that we can utilize all the data that Zach just mentioned and alluded to here, and really bring that level of transparency to the market, and so you can help react quicker than ever before and minimize risk, de-risk the market, as Craig mentions. One of the great things about FreightWaves and our team here, the market expert team, is we have an abundance of resources here. I think, as Craig likes to refer to it, as tribal knowledge, right?
That's right. We're one of the chiefs.
We're one of the chiefs in the tribe, yes. And how we can utilize those years, those decades of information and translate it into actionable insights here.
Right. Good to know.
Yeah.
So yeah, we've got a lot of different experts in various fields here. We're basically an aggregation of both data and human resources. A lot of people from across the industry, final mile, supply chain, shipper, carrier, broker, you name it. We've got a huge amount of exposure to, a lot of industry experience here, specific to the transportation industry. And data plus tribal knowledge, obviously that's a big thing, because without the context of what the data means or what, how it exists in the real world, you really don't know how to use it. If I could throw a number up there, I could just say, hey, Anthony, 45.3. And Anthony would be like,
what does that mean?
Great. So without knowing what that means, that's basically the concept of adding the tribal knowledge to it. We're basically going to translate that into what you can do with it.
Exactly. And for today, we will be going over quick rundown, some recent freight economic performance, year-end outlook as we start to get closer and closer to the end of the year. We're in the final quarter calendar, so to speak. I know, Zach, you're probably familiar with many fiscal.
Oh man, the fourth quarter. It's a big one.
Yes. We're looking at trends in manufacturing, global slowdown, and all aspects of freight. I know you have quite the rundown for us today, Zach.
Oh yeah, I do. But first up, you've got some big news.
I got some news. So for me on my end, we're going to go over durable, non-durable goods, and generally the state of the consumer, because that's really going to be the forefront of the U.S. economy.
Yeah, especially in the fourth quarter. For
Yes.
me, I'm going to recap basically what we've seen over the last 3 weeks, 3 to 4 weeks, as well as giving a little bit of a peek into the month ahead, as well as a few more months ahead, moving forward on capacity and volumes. So volumes have basically been a big story this year. We've seen a lot of fluctuation in terms of how it relates to 2018, which was a robust freight market by most people's measures. But capacity has been a lot more excess than it was last year.
Right.
So we're not seeing a huge change there, but we're about to see some changes.
All right. So kicking off here with industrial production and the ISM PMI. All right. So for those of you who are not familiar with industrial production, total industrial production is going to account for manufacturing, mining, utilities, things like that. But the big chunk of it is manufacturing. So that's going to account for well over a third of overall industrial production. And what we have pulled up here is year over year change. And we have that overlaid with the Institute for Supply Management, their PMI, the Purchasing Managers Index. And so when we're looking at that, we see, of course, a pretty close correlation here. The ISM PMI in that green line, if we look at that 2009 dip, we can see that there was a dip down in that green line in that chart for the PMI before we reached the bottom for industrial production. So that's to really drive home the point that industrial production helps confirm some of the aspects that we're seeing in the greater manufacturing side of the economy. But it's a little bit behind when it comes out to the data releases. But the PMI and some of our internal indicators that we'll get into a little bit later give us a bit of a more forward look. So for the PMI, we saw that it was down 0.4% in September compared to August. So that there was a month-to-month decline. Additionally, we saw that there is a 0.1 decline for the month on a year-over-year basis. So you might be thinking to yourself, a 0.1% decline, Zach. That might like, oh, that's not that big of a decline. But the thing is, that's the first year-over-year decline since 2016. So it's a bit of like that threshold, so to speak, of like, oh yeah, it's going down, it's going down. Now it's below that year ago level finally.
Yeah, no, that 2016 number too. I think that probably holds true for a lot of people in the freight market. I know 2016 for us was a struggle,
right?
Because we did not see a lot of the volumes that we had seen in previous year. Didn't really know why, but yeah, the manufacturing sector really does drive a lot of the freight economy.
Right. And when we're looking at manufacturing right now as a whole, headwinds really coming from the trade side of things. I think that's going to be a common theme throughout some of my talking points. I'm sure it might pop up in one or two of yours as well. Of course, we have strikes. General Motors, I believe, Zach, is that it?
Yes.
General
Motors.
Was that a thing?
Yeah, it happened.
It happened. So there's that. There's also slower global growth. And a stronger U.S. dollar. So there are all these headwinds that are really in the face of industrial production and manufacturing.
And I want to ask you real quick, we're going into an election year next year. What do you think that means for the economy moving forward? Since we are in this kind of uncertain arena, especially with the China situation, trade wars, some strikes, we do appear to be slowing some industrial growth for sure. What do you think the election is going to have? What impact is that going to have?
I think so. I think with the election coming up, some of the impacts that we can anticipate will for sure come from a global standpoint. Yeah. So I think when we had President Trump first enter office, there was a lot of changes, right? So a lot of the deals that the Obama administration worked out, he's like, nope, no more with this, or we're changing this, we're rewriting this, we're working this. So a lot of those changes were huge on a global scale. And so I think many global leaders are going to be maybe more uncertain or unsure as to, hey, this being an election year and this is a new deal that's being worked out, how long is this going to stay in place?
So basically more uncertainty.
More uncertainty, yes. Right. So getting a little bit more into the industrial production and ISM side. So that previous slide really laid down the groundwork of there's a close correlation, right, between industrial production and the ISM. There's also a pretty cool correlation between our tender rejection indexes and the ISM Purchasing Managers Index, the PMI. And so when we're looking at the PMI, we see that it is down to 47.8. For those of you that are not familiar with the PMI, real quick rundown, 50 is the threshold. So anything below 50 is indicative of contraction. Anything above 50 is indicative of expansion and growth. When we're looking at the PMI, this is a survey that's sent out on a monthly basis, and it has many different components. There are new orders, backlog, shipments, employment, things like that. But when we're looking at the overall PMI, this is aggregate, the diffusion of it's almost like the sentiment for the manufacturing side of current things in the pipeline and what their current feelings and outlook is with their books for the manufacturing segment.
Yeah, the OTRI, the FOTRI, the flatbed outbound tender rejection index you've got pulled up there. I think that one definitely coincides with manufacturing a good bit, manufacturing and construction specifically.
Definitely.
You know, as you are shipping less freight across the country, obviously that's going to help lessen the strain on the demand or the supply side. So as people are also adding trucks, that's also less freight to move.
Right.
So as the manufacturing side is kind of slowing down, how much of the economy is based on manufacturing? Do you
say it's right around 12 to 14%,
Yeah,
depending
so
on which outlet you look at.
we're really not a big manufacturer anymore, are we?
Right. So when we are looking at manufacturing, a lot of it is going to be overseas, but a lot of it, I think, much to the chagrin of some, is going automated. You know, with
Right.
like a lot more less people, more machines, manufacturing machines. Some are in favor, of course, some are against. But that's just the reality of the situation is that a lot of the manufacturing, a lot more of it's becoming more and more automated.
Right.
For sure.
But in terms of production of goods, though, we're still kind of producing less, are we not? A lot of that comes from China,
A lot's
Malaysia,
coming overseas, correct.
Right on.
And so one of the reasons I really enjoy industrial production is because it's like it's broken down in so many different segments. And so there are durable goods or non-durable manufacturing, durable manufacturing, durable and non-durable, really having that 3-year shelf life. So anything under a 3-year shelf life is going to be considered non-durable. Over 3 years is going to be considered durable. And so that's one of the awesome things I love about the Census Bureau data is because it gets broken down into so many different segments. One of the things I love about our data is that it's on a high frequency.
Yeah,
so
every day.
every day. And when we're looking at our data, we can see a really cool correlation between our refrigerated outbound tender rejection index, our OTRI. What we call that, the ROTRI?
The ROTRI.
The ROTRI.
The reefer outbound.
The reefer
so
outbound.
That's going to be your temperature controlled carriers out there. So
yes.
I love this correlation. So,
yes. Yeah. I was excited when it popped up. I was like, oh, that makes sense. Eureka. And so what we see here is that within non-durable manufacturing for industrial production, roughly a third of it is going to be made up by food, beverage, and tobacco products. And so goods, of course, that need to be in those temperature-controlled trailers. And so when we're looking at our reefer outbound tender rejection index, as you mentioned, it's updated daily. So even though we use the monthly segments like indicators like industrial production to see where we stand. It helps confirm trends that we're seeing in our tender rejection indexes. And so what we're seeing right now is that food and beverages were up. And as I mentioned, it represents about a third of non-durable goods manufacturing. Where it went down was chemicals and rubber products production. So I believe rubber products production was down 0.5% and maybe 0.2 for chemicals. So that the declines there were too much for food, beverage, and tobacco products to make up for the overall decline within.
Because they're only a third of the index.
Correct.
Yeah.
So it wasn't quite enough to overcome that decline. But you could probably speak to, we are seeing some seasonal trends. I believe potatoes.
Yes, it's potato and apple harvest.
Yeah, so
yes.
We have those seasonal trends that are still helping keep reefer outbound tender rejections in those double-digit levels.
Yeah, I'm going to hit on that a little bit later.
There we go.
Yeah.
Keeping on our industrial segment, real quick, a little bit of a summary. So as I mentioned earlier, with the ISM, there's a new orders component. And so ISM is already a forward-looking indicator, as we saw compared with industrial production. But we saw ISM in the headlines once it hit below that 50 mark, lowest in over a decade. Not a lot of talk about the new orders component, which is even more forward-looking. So it's looking at trends that are what these manufacturers expect to happen in the coming months. And so when we're looking at new orders, that's really telling us what's in the pipeline for manufacturing, what's on tap for production, what's going to be on tap for shipments. And so I think that level of 47.3 reading is really,
that's concerning.
It's
especially
concerning.
For freight.
Exactly.
As a lot of people put in their capital expenditures, businesses do more investment, so that means they're going to build more products. They're going to need more equipment for their warehouses, manufacturing facilities, whatnot. All these things kind of lead into a very slowing of the growth, if you will, that we had in the previous 7-8 years. So I think this one's actually pretty. This one concerns me probably more than the others, because it is new orders. And that's the things that they haven't necessarily built yet. So you're looking at anywhere from 3 to 9 months out, shipping.
Exactly. And the other part of it is when you don't have that many new orders coming in, you start going into backlogs. And so one of the things that they mentioned in the survey is that backlogs are being drawn down. And so that's concerning as well when you're running low on new orders, that's contracting, and now you don't have any backlogs to kind of go through. So that really kind of amplifies that necessity of a trade
so effectively
deal.
your warehouse is empty.
Yes. Yes. And so that's going to be a concerning one. So like the PMI, we have a logistics managers index. Similar to the PMI, it's still based around that reading of 50. This is giving more of a insight into the logistics side of everything. So we're talking about inventory, warehousing, transportation, pricing, pricing for inventory, pricing for warehousing, pricing for transportation, capacity for inventory, warehousing, and transportation. So it's looking around 8 trends. This is a study that's put out, I believe is by a few universities. It's several. I think Colorado State, Arizona State, Rochester Institute of Technology, I believe maybe Maryland, and there may be one. I'm so sorry if I forgot one of those, 2 of those.
I don't remember all of them off the top of my head either.
But it's definitely a collaborated project effort. Yes, that pulls this all together. And one that I think really cool components of it, of course, was the LMI transportation prices. And so we can kind of see a close correlation here between our outbound tender rejection index. And so what we saw in the most recent month for the LMI was a reading of 50.6. So this was a slight bump up after I think 3 of the last 4 months were in contraction for transportation prices in LMI. And so that bump up, I think it corroborates slightly with what we're seeing over that same time with tender rejections. And so, of course, tender rejections, Zach, you probably a little bit more well-versed in explaining this, but looking at tender rejections, it really helps with looking at the capacity on the market, a lack of capacity, really going to start to drive up prices because drivers can be a little bit more selective with what loads they're going to haul. And
I think this is very actually this correlation is great because we're really seeing a horizontal market right now. We do have these seasonal bumps, but they're very muted. If you look at the LMI over the last several months, if you pulled this all the way back out in a year, you would definitely see that mountain grow.
Right.
As the rating environment in 2018 cooled off rapidly coming into this year. And that's definitely reflected here, and it's kind of interesting to see those little minor bumps in the LMI, which is a survey. It's a sentiment index. It's very tight. I mean, you can see the correlation with the daily OTRI.
Right.
So as OTRI, tender rejections go up, as carriers, those that aren't familiar, as carriers reject more of the loads that are tendered, that's going to put upward rate pressure
Right.
in the spot market and on contracts eventually,
Right.
if it stays elevated long enough. So the transportation prices going, slight up. I think that actually is very accurate in
Right.
terms of reflecting what's going on in the industry. But again, it's very close to 50. It's
Very
not
close.
like we're seeing like these huge 5-10%
Right,
jumps
right.
that we saw in 2018, or these 10-15% declines we saw earlier in the year. So,
Exactly. And shifting gears here, we're gonna that was our more of a manufacturing and industry viewpoint. Now we're looking more on the consumer side of things. And so quickly, we're looking at consumer consumption. We're looking at personal consumption expenditures for durable goods. We're going to get into retail sales a little bit later, but one of the things to really look at when we're looking at personal consumption year over year for um, durable goods is that there was a slight bump up, 0.1 in August. There, it's a bit slower than
such a lag.
yeah, it's such a lag.
Yeah.
That's why we need the sonar OTVI.
Right.
It's a slight bump up from August. It's a bit muted than consensus estimates were expecting, but the bump up nonetheless will help contribute to volumes. And I think in the next one we have retail sales. I believe
Here's
we do.
the big one for this quarter. Really,
Yes.
is retail sales, and it's been the one that's been the strongest.
Right.
If I'm not mistaken, over
Right.
the last 12 months. Retail, I mean the consumer.
Yes.
Swooping in to save the day as usual.
and as you mentioned, the consumer is just under, I believe, 70% consumer expenditures when we're looking at GDP. So it's a big part of the U.S. economy. Everyone is all eyes on the consumer as we get into that holiday season here. And as we inch ever so closer to that holiday season, we saw our first monthly decline in retail sales. And
Of course.
so this is our first monthly decline since February 2019. And so this was a bit of a big headline when it first popped up. Of course, when we're looking at consumer goods being bought, these are going to be also added to that freight volume that gets transported throughout the country. But when we're peeling that back,
so is this really just a slowing of the growth, or I mean, it's not like it's contracting.
it's not
right?
contracting.
Yeah,
It's not contracting, but it is everyone, since I think that the emphasis has been more and more magnified on the consumer.
Sure.
It means so much more now.
Yeah, I get it. No, it's 70%.
Yeah. And so everyone's just like, no, not our star player.
Yeah, right.
But we are still hopeful for that year-end component of it all. But within it, we have non-store retail sales. And so that still had double-digit growth. I believe it was just around 12 or so percent. But that saw the first decline since December 2018. So
and that's going to be your e-commerce.
e-commerce,
Yeah,
includes
yeah.
online sales. And so that's,
Big old Amazon.
that's concerning.
Yeah.
And when we're looking at it, of course, it's going to be dependent on not only the consumer confidence levels, Zach, as you and I got to chat about,
Right.
but also the facts, as you like, the employment trends, wages, things like that. When we're looking at employment, I believe unemployment rate was right around 3.5%. Participation rate is still relatively high. Wages are still sustained or substantial.
They're still growing.
They're still growing.
Yeah, right. So we have employment levels growing still,
Right.
or they're maintaining.
They're maintaining.
And then we have wage growth, which I mean, at the end of the day, if those two things hold steady, we can rely that the economy is still in a pretty decent spot.
Right. And one of the things that I think is going to be prevalent here in the next slide, but when kind of going off of that whole retail and employment side, when we peel back employment, although it's still historically low levels, I don't know about you, Zach, when I look at the economic trends, things that keep me up at night,
Right.
When I'm looking at the econ side of things of employment, peeling back that layer of where are these jobs? What kind of jobs are being fulfilled? And so when I'm looking at that, there's a lot in the service side, of course, especially healthcare, things like that. but a lot of these roles are not high-paying positions. And so when we're looking at those segments that are fulfilled, I think that the median salary for many of those are, just over 30,000, below the national average. Maybe some get into the 40s. And I mean, that's great because I think in an efficient economy, we need to have all satisfied segments filled where there is a demand for labor and a willing participant to supply that labor.
Right.
But that's to say that when we're looking at the amount of roles being fulfilled, I think there is some room for concern where a slight chink in the armor for um, wages that are below the national average, that can kind of have a bit of a
Offsetting effect.
offsetting
Yeah.
effect. Yeah.
So we're growing, but we're not, and we have these, pretty healthy employment levels,
Hmm.
but they're not necessarily, it's skewed towards the low end.
Right.
So
Exactly.
these people aren't going to be the ones that go out and buy a bunch of goods, for
Right.
instance. They're going to be
Right.
on tighter budgets, not necessarily driving as much consumption as we may
Hmm.
think.
Right. They might have a higher propensity to spend, but uh, that their purchasing power not as high. Not
Exactly.
as,
There we go. That's
yeah,
well
yeah.
said.
And in this one, real quick, we're looking at retail sales of furniture. Although when we look at housing starts and things like that, there's been a bit of a modulating effect, not quite meeting the demand side. There's been supply side issues with the existing homes down, sales down. Again, not so much for the lack of want, but lack of inventory, things like that. Was down throughout the entire U.S., every single region. But people are still buying furniture. So it may lean to suggest that maybe folks are looking to just revamp their interior spaces instead of waiting out for a new home or make that move into existing home or something like that, just because that limited availability there.
Do you have any insight into the remodeling or the refurbishing that type of activity in the economy right now?
We do. So we don't have the data in here yet, but I do have a close friend that I work with that I need to catch up with soon. But what they were seeing is that there's going to be more growth, continued growth for remodeling segment, but it's going to slow, I believe. They're expecting slowing trends for remodeling growth in 2020 and throughout that year. So I think once we see, I think for remodeling side, I think the psychology is going to be if there is high demand for your home, um, maybe the onus isn't on you. You don't have that much competition. It's like, no,
Right.
you're going to buy it as is because you want this house, this entry level home or mid level home.
Mhm.
I don't have to uh, redo the windows or siding or roofing or floors, things like that, because I know there are 5 people behind you that are lined up to bid on this home here. So I think once we see a swing in that pendulum, maybe there will be more onus on sellers to try to remodel to make their home more
Right.
appealing.
There you go. Okay. So that might actually look a little bit more positive
Exactly.
eventually. uh, all right. So let's dive on into the freight market update. Thank you, Anthony.
Of course.
All right. So here's our outbound tender volume index. So we started off the month of October. Actually, everything declined as we would expect it to at the end of the third quarter, beginning of the fourth quarter. Volumes came down about 5 to 6% real fast as shippers took a big sigh of relief, saying, we fulfilled our quotas and our orders, got them off the dock. And it actually dropped to a level that was as high of a discrepancy between 2018 than we'd seen since, say, sometime way back in, I guess August it was, for just a hot minute. But this discrepancy was a lot better. We hit about a 7% difference at one point between 2019 and 2018 in terms of outbound volumes in the United States, which was a good sign. We thought this was going to be a continuation of the trend. However, that trend of year over year growth and exceeding 2018, which was just so robust, has fallen back down. It's now, we're roughly about 1.8% higher today than we were this time last year. And you can see there's a slight, there's a converging, you know, effort there between 2018 and 2019 over the past several days. That's got us a little bit concerned. It could just be a correction after being so much better in the first week of the year, but still, as we all have talked about ad nauseum, the market is at a lot more supply than it
Right.
was this time last year. Rate pressure is still just not there to the extent that we would normally expect with this level of volume. So again, this is still going to be, I think, the softest time of the quarter. Anytime you start a quarter, that should be a traditional low point in the quarter. You don't see a lot of lulls except for the first quarter. The first quarter is just terrible in general for freight. But this should be the low point for freight in the fourth quarter as we near peak. So regional volumes. Here's where we're seeing it broken down. We have a lot of, the freight market itself is a fluid place. You don't just have the same volume coming from the same markets year over year in the same manner. That would be extremely boring, and we wouldn't have much to talk about. So, like you mentioned earlier in your presentation, we've seen West Coast volumes really grow this year. A lot of that's driven by the ports. All this pull forward of the freight, et cetera, has fueled a lot of warehouses on the West Coast. But not only that, but the potatoes and the apples. We've had a pretty decent, showing of the harvest this year. It's not disrupting capacity like we'd seen in years past. And that's really more of a function of the fact that the market itself just has so much supply in it. It's really going to be difficult to hit that inflection point where you're going to see increasing truckload rates driven by these produce movements. There's going to be carriers sitting at every field waiting,
right.
To pick up their loads of apples and potatoes and grapes in California and whatnot. So the West Coast really driving a lot of growth this year, and the Southeast and Midwest are just disappointing. Midwest is actually, the way that we have this divided up, the Midwest actually commands the majority of the volume in the United States in terms of truckload movements. So when that goes down, that's a big sign. The Northwest, not a lot of volume there. So the growth there maybe not as impressive as the Midwest decline, but it's still worth noting that we're seeing such significant increase. I mean, a 30% increase year over year is nothing to sneeze at in a region.
Right.
The Southeast continues to be disappointing. You see that trend line down there. This is the year over year growth in outbound tender volume. So what you're looking at is a percentage growth versus the same time last year. So right now, the Southeast is roughly, 6% down. If I'm reading, no, it's 3% down. 3% down. I'm sorry. Year over year, and the Midwest is 6% down. Now, the Southeast actually was showing signs of life earlier in the quarter, in the third quarter, I should say, and by being a little higher than flat even, dead even. And what we've seen is we're now getting some more difficult comps out of Savannah. Savannah just woke up last year.
Yeah.
It really became a strong market, outbound market for freight. It used to be a place that I know I personally used to avoid back in the day. But now it is just a booming market. And last year we saw some sort of like astronomical, it was exponential.
Right.
Like all of a sudden in October, volumes just blew up because we had, and I'm going to hit this a little bit later, on our maritime side, we saw a lot of robust growth coming out of in the ports due to all the overseas shipping. Now, a big story last month was the GM auto strike. And this is a deeper explanation of what we've seen in the Midwest. The Midwest struggle. So when the Midwest has a lot of problems with freight movements, that's not a great sign for the truckload economy or the freight economy in general, or just anybody that has a truck. And like, it is not a good sign to see the core of the freight market really fall off in terms of volumes. And two of the biggest drivers of that this past month have been the GM auto strike.
Right.
A lot of, downstream effects.
Mm-hmm.
You have a lot of parts and suppliers that aren't moving anything. And it's, you see it's costing GM some ridiculous amount of money. So the good news there is that they will turn those back on eventually, but that may actually create some capacity issues in the near term. What's more concerning is that the Joliet market down there in Chicago, it used to be the nation's third largest market, now the sixth largest market in the country, because it has declined so much year over year. We're roughly 20% down out of Joliet. This is basically what I consider like the nation's hub.
Gotcha.
In terms, because you have so much freight interaction in Chicago.
Right.
You have, intermodal, a lot of railheads sitting in Chicago. I mean, think about the way the nation was built out.
Mm-hmm.
a lot of things intersect right there. And so that means that over time, all these warehouses, DCs, distribution networks were built on intersecting in Chicago. It really connects the East and West Coast. A lot of the reason that this has declined is because shippers are skipping. They're skipping over. They're shipping to Savannah, and New York, and New Jersey, and all that, and they're not going into LA as much as they used to, and then shipping to Chicago on the rail, and then south into the the Southeast anymore. It's not. Well, they're still doing that, just less frequently.
Gotcha.
Yeah. So that's. The coasts have really taken over the load volumes this year. The inland markets like Atlanta, Chicago, Joliet, really not doing as well. And you can see that in the next slide. The rates are really, they declined sharply to begin the year. 2019 kicked off. I think everybody expected. I think that was really a correction, that big decline in January last year. I don't think the market was quite as hot in the fourth quarter last year as those rates might, even our tender rejection rates might imply. I think what we were dealing with was a lot of people just expecting the market to continue to be, undersupplied and capacity. They were just accustomed to, everything being overheated a little bit. They were just expecting no trucks to show up, et cetera. So even carriers, obviously, as the tender rejections are elevated there, as you see. And then once January hit, it was like, okay, we expect things to cool off.
Right.
Then they just continued to cool off, like beyond what I think most people would have anticipated. The market really softened a lot. And then, our summer peak, the freight market has traditionally about 2 peaks a year, one in the summer, one in the winter. And one of them is driven more by your construction and manufacturing and, your bottled waters and beverages and things like that. And the other is driven more by retail consumer activity and, in the retail sector. So we are now in kind of a flat market. Like your LMI pointed out, the tender rejection rates have really not moved that much. They fell to 4.7% from 5.3% from the start of the month. That's not a huge drop, but it is a drop. And, you see that reflected in the rates as they've dropped on average. That's our national rate index, DAT rate index, excluding fuel. That's dropped about 3 cents per mile on average.
Now, with capacity like this, is this something that you see as being sustainable?
This is actually a pretty, I don't, again, sustainable to me means that nobody exits, nobody enters the market. That's an equilibrium.
Right.
You want to be as close to equilibrium as possible. I don't think we're at an equilibrium because I think the market is oversupplied. There's, you look at any of these reports, you see these soft earnings. In some of these larger carriers, we know that there's being accelerated exits from the market. And this, to me, is more of a corrective year. I think that's actually going to flow into next year a little bit as, you can't operate at a 98, 99 OR for long. You can't operate at a 102, obviously, but a lot of these carriers carry debt. And you have to make more than 2 to 3 cents on the dollar to survive. And I think really the mid-sized carrier is the one that's most exposed in this situation. They have, gone out and bought several trucks, expanded their fleets, expecting the shippers to continue, number one, with the volumes that you saw in 2018, and then they expect to expand their market share.
Right.
And now the volumes aren't there, and that's why you're seeing these rates really collapse. Right. And they're just, even when volumes are as high as they were in June, the rates just aren't responding.
Right.
And that's why you're not seeing this real tightening real fast, is because there's a lot of carriers out there that have realized we've got to keep our trucks moving. Utilization needs to remain high for us to just survive. They're all in survival mode right now. And of course it is bid season.
Right.
A lot of these ORs are probably going to come down next year because these contracts, like you see here, the DAT National Long Haul Rate Index, I've got the last 4 years pulled up. And you see that blue line down there, that's where we are right now. And we're starting to come in line with 2016, the dreaded 2016 year. The problem with 2016 is that the costs at that time were just not as high as they are now. We had a rapid inflationary environment in 2018. And that doesn't just mean for the economy, but for the freight, a lot of the truckload carriers, all their vendors came in because the economy was booming. So all the costs went up.
Right.
They went up rapidly because they can. Trucking people aren't used to getting cost increases, or freight. They can't go out to their customers and get 8-9% increases. Well,
Right.
they did in 2017, 2018, but that is not standard. A lot of these other vendors actually can come out there, like insurance.
Mm-hmm.
It's obviously a huge increasing burden on carriers. Insurance costs really climbed because, this inflationary environment you see, it overheated,
Mm-hmm.
and now their bills are a lot higher than they were in 2016. So that is a pretty rough sign right there to see those numbers start to intersect a little bit. We had been riding just above 2016 for the majority of the year, and now we're starting to come more in line with it. Now, the comp is actually a little bit deceiving in the way that the market was recovering at this time slightly.
Okay.
So it's not necessarily the worst thing to see. We did survive with a little bit of contract stickiness throughout this year, but unfortunately, these next year contracts may reflect a tougher situation. So I pulled up the forward curve for the futures just to see what the market participants are thinking about this upcoming peak season. And these are forward curves for the futures market. And people are basically expecting rates to spike still, back up to $1.52 a mile. Coming into, everybody's still really optimistic about what's going on with the freight market this peak retail season. I don't think that's necessarily the worst thing.
Mm-hmm.
I hope they're not disappointed,
Right.
but at the same time, shippers out there really need to be on alert. If this kind of spike happens, that can really be disruptive to what they're doing.
Sure.
Especially if we see some real surging in volumes and this capacity really start to come offline. I don't think we're going to see necessarily a huge reduction in capacity till the first half of 2020.
Okay.
So I don't think the supply is going to be that hard, but keep in mind, this sets up a lot like 2016
Mm-hmm.
in the way that it was a very soft year. People got really aggressive with their contracts. Shippers got great deals, but
Mm-hmm.
then all of a sudden at the end of 2017, those deals didn't matter anymore.
Right.
Which is going to be, especially in this uncertain environment, a lot of shippers out there are trying to figure out their own budgets for next year because they don't know what to expect with their trade situation. They're out there busy trying to redesign supply chains and whatnot, getting around some of these tariff increases, and obviously the global economy's got a lot of uncertainty in it right now. Brexit's happening
Yes.
at the end of the month, and IMO 2020. We've got a lot of things going on in the global economy that are making them really uneasy right now. And so shipping in the country is probably going to be something that's, down the list of priorities to worry about, especially since they've had a very flat market over the last several months.
Right. Right. And I can only imagine some of adding on to that uncertainty. December 15th is still a big question mark, even as we have a bit of a ceasefire, so to speak, with trade negotiations. Even if that goes through phase one, that December 15th, I know, is still uncertainty, and that has a lot of consumer-related products that would also lend to that. I think some of that volume and taking up some of that capacity as well.
Yeah, no, for sure. And, I was just illustrating here in this slide about how, we did have volumes on the West Coast, Northwest, and the California, Arizona area. Volumes increased there just as much as they did in the Northwest. But tender rejection rates actually surged in the Northwest. And that's because that market tends to be a little bit more volatile because trucks don't go there unless they really want to.
Right.
It is a backhaul area. So the harvest did have a pretty decent impact this year, not as big as last year, obviously. But again, I think this last year was magnified by the fact the entire country was in a bit of a unstable space. This year is far more stable, but still, this is nothing to sneeze at in the Northwest. We had some decent disruptions here this quarter. Now, this is the slide that I think should raise most eyebrows in this presentation on the freight markets. So I wrote this article, the chart of the week. I wasn't entirely happy with, I didn't feel like I was as clear as I needed to be in what I was trying to say, but reading back over it again, my point was, so this is the customs retail shipments coming from overseas all over the world into the United States. And it's simply tagged retail trade. So this is going to be your Targets and your well, no longer Toys R Us, but
R.I.P.
yeah, yeah. All the big importers of goods that you see on Amazon. This is going to be representative of those goods coming into the country. Now you can see what I have overlaid with it is the maritime shipping rate for the 40-foot containers. And you see the retail trade shipments really drove a lot of the volatility and the rates in the over the last year and a half,
Right.
maritime. Now what this means for internal shipping is that this huge peak that you saw back here in October of last year, that big blue mountain, that's not reflected this year. You see August, which is your standard peak
Right.
for imports and shipping, August, September, nothing like what we saw there. There's two things that are happening here. One, the big pull forward really lowered the need for them to bring in as much freight this year as versus last. But number two, this peak is so far below last year. A lot of what I think was propping up the freight market in the first half of 2019, was this activity right here. There's a lot of pull forward. We saw a lot of increased regional warehouse movements around Los Angeles, up to Northern California, into Phoenix. Not a lot of long haul freight. A lot of it just simply came into the country and sat on the docks, sat in the ports, sat in warehouses before getting moved. We saw a big increase in longer shipping over the last month, where we think a lot of that freight has been pulled into, the DCs where they needed to be. What I think this means for the first half is actually that we may not have anything to prop up volumes in the first half like we did this year. So that to me might be the big reckoning for the freight market coming up.
And I think some of the underlying trends, because that was really heavily related on retail and consumer aspect of it all. I think, maybe even as we get to the 2020, 2021, 22, 2025, I think I don't know if you agree with this, but there might be some muted seasonality on the retail side as we see the growth of e-commerce. More DCs plopped up throughout the country, and we have Amazon Prime Day, right? Christmas in July.
Yeah.
We have, are there going to be more new e-commerce holidays propped up in the middle of the year or beginning of the year that's not, traditionally during our seasonal patterns that we used to see in the past, but maybe we'll see, Prime Day once a quarter. And now we have to have competition with other e-commerce outlets or competitors. And so I think that'll be really interesting to observe in the coming years.
Yeah, that's true. So real quick, start tying this up a little bit. Diesel price activity. We did see, that big spike around the Saudi attacks, and it did recover a little bit, but it still seems to be uncertain. So diesel prices are in a bit of a holding pattern, sort of like the freight market right now. The price of diesel, both on the rack and on retail, kind of found their equilibrium for the moment. Regionally speaking, though, there are some disruptions up in the Pacific Northwest, at the pipeline up there having some issues, but generally in the United States, diesel prices are flattening for the moment. This is a big deal because we've got a lot of uncertainty around this moving into 2020 with IMO and that impact there. So air cargo, we're not seeing the peak that we would expect for air cargo right now. That's not great news for the air industry or necessarily even the trucking industry. Shippers are still they're able to ship relatively cheap on air, which is more of an expedited move or the high value freight. And it's not moving right now. So that in general is kind of a weak sign coming into peak for retail, what we're about to see. Anything coming from China right now, Asia, you're getting a discount. Yeah. So go ahead and ship it now. And then intermodal volumes continue to degrade year over year. A lot of this is probably going on the truck for different service freight because the rates are so comparable. They're able to really ship for almost nothing point to point rather than, putting it on the rail, taking it off the rail, moving it into the DC. They can just go from, port to facility or, without the intermediary movements. I think that's a lot of what's happening here. That's the long haul outbound tender volume index. It's increased, 13% year over year, whereas intermodal volumes are down roughly 5 to 6, as well as trailer on flat car, which is significantly lower. So in summary, volumes continue to outperform 2018, but not as strongly as we were seeing in September, August. West Coast activity really driving a lot of the volumes right now. I think a lot of that is certainly just stuff coming out of they've been sitting in a warehouse for 8-9 months. And now you're seeing a lot of that getting pushed into the East Coast, even though shippers are starting to trend towards the East Coast shipping from overseas. Retail shipment decline, not good news. Could be a rough first half of the year. Hopefully the fourth quarter proves to be the savior and the consumer comes swooping in at their big S on their chest and save the day. Capacity, flat right now, but it is still actually better than it was this spring. This spring was a very dark time in terms of freight markets. So we're still looking okay from that aspect.
All right, jumping right into Q&A. If you haven't already submitted your questions for Zach and Anthony, go ahead and do that through the Q&A button in your control panel. For those we don't get to, we will follow up with you after the presentation. First question, you made mention to spot rates falling from $1.42 to $1.39. Is that a specific region or general?
That is the national long haul freight rate. So it's an average. So we have, all the regions represented in that index. So it's not just one region. It's the national rate. It's kind of an index. So we have that developed for freight futures. So it has to be without all the accessorial charges and fuel surcharge and anything like that.
Awesome. And can you provide a little insight into how the trade war is impacting domestic air freight?
So we're seeing, we're not really seeing a lot of, increased activity on the domestic side. Really, I think the trade war has a less of I guess indirectly the trade war is having an impact in the way that it's making shippers uncertain, and that's in turn lowering the volumes in the country, which is keeping the surface freight rates low, which is basically now people have, easier access to shipping. They can, carriers are able to ship things faster anyway, because they're desperate to get things from point A to point B. There's less traffic. And that's keeping a lot of the domestic air freight rates suppressed as well. So it's connected. I mean, we made a connection back a year ago about how tied together the surface freight and the air freight is. The Los Angeles to Dallas lane, for instance, really moved almost in perfect correlation with the air freight rate from Hong Kong to Los Angeles.
All right. And next question. With high tender rejection and drawdown backlog, do you think this will impact consumption and in extension impact consumer confidence, which has been a major focus in recent times?
I think that's definitely going to be a factor in consumer confidence. When we're looking at any kind of headline items, even if it's largely on a segment that's not as big as consumer spending, if it's on the manufacturing side, it has nothing to do with the consumer. And even if the costs haven't been passed down to them, you might see a higher propensity to save rather than spend. So I think that can definitely play a factor into that aspect as well.
Okay. And what is your take on the YRC consolidation? Will union carriers be able to maintain year-over-year growth?
Oh, that's going to be increasingly difficult. I don't, I don't think that that's really going. No, I don't. Just to put it bluntly, no, I don't, because the higher costs involved in a union carrier are going to just eat into the margins. I mean, they don't have right now. Carriers don't have the pricing power that they had in 2018. Insurance costs have gone up significantly, along with numerous other factors. Really, it's going to make it increasingly difficult for union carriers to operate in this environment. We saw several of those go under last year. And, unless you're really dug in and are able to, regain some level of pricing power with your shippers, that's going to be a hard one.
Okay.
Mhm.
Next question. If the market is correcting itself, is now the right time to refresh contracts?
Yeah, from a shipper's perspective, it's a great time because the market is essentially flat. This time of year, I would get inundated with bids, and you're always prisoner of the moment. You're going to be in meetings that are telling you that capacity is prevalent, and you need to make sure that we win as many accounts as possible. And I'm sure that's what a lot of carriers are doing right now as they prepare for 2020. They have increasing. A lot of fleets have increased in size year over year, not necessarily right now, month over month, but that's going to put a lot of downward pricing pressure on them right now.
Okay. And next question. Can you explain how there could be a retail pull forward? Don't goods go stale given consumer trends? For example, last year's sneakers are not as marketable this year.
I think so. When we're looking at the goods, that's definitely going to lend to what's durable, what's non-durable, of course. When we're looking at pull forwards, I think it's also going to lean towards um, what can stay in warehouses for that long. But I think the pull forward that we're going to start to really see is going to be more so now in the coming months as we get closer to that December 15th mark. Um, Things like electronic goods, appliances, furniture, stuff like that. I think that those are the items that are most likely going to get shelved.
Yeah, and you see a lot more discounts when we have increasing inventory levels.
Mhm.
You'll see a lot of things that you didn't know. I mean, think about TVs. They haven't changed that much in technology over the last 12 months. What'll happen is they're going to simply to order less because those are items that they order and they make really fast.
Mhm.
So it's that retail pull forward wasn't necessarily TVs that you saw. It
Mhm.
was, it was other things that are more raw material like items, not necessarily raw materials because they're retail goods, but they're things that you can see 12 months later
Right.
and it'll be just fine. And
Components.
yeah, they'll put them on a shelf in a dollar store, now or last year.
Right. Right. Right.
Great. Next question. With so much excess capacity, will it take fleets and owner operators closing down to resolve that excess?
Unfortunately, I think that's accurate for now because we're going into this election year. We're seeing a lot of slowing in the demand side on both, just like I showed you with the retail side, and Anthony showed you with the industrial and manufacturing side. We don't produce a lot here right now. Looking at some of the other things we bring into the country, those aren't down as much. They're not quite as volatile either in terms of raw goods and materials. But at the same time, if we're not producing anything, you're not going to be shipping anything. So that is going to make the demand side forecast look rather soft in the next probably 8 to 10 months. So it is going to take a supply side correction to really bring the market back. And that's what we saw in 2016. And it happened in as quickly as it was probably, I would say there was probably about an 8 to 10 month cycle
Mhm.
where we saw the market bounce that rapidly. So
Great. Do you have any data on dedicated contract carriage rates?
no, not at the moment. Most of our data is on the contract side. Some of that is dedicated, but it is, largely, just a general contract, not necessarily a dedicated move. It's, a shipper agreeing to an agreed rate. They don't own the truck. They don't have the dedicated power over it.
Great. And what is the best predictor of capacity leaving the market? What does that look like now, and when and how do we get to an equilibrium?
So something we look at in Sonar is the tractor counts, and right now we're seeing tractor counts continue to increase in the smaller fleets. They're basically they're decreasing in the larger fleets. So you add all those together, and we see basically tractor counts are still slightly rising right now. That's going to start to turn down probably in the coming months, especially as we hit January, because people if you looked at the Class 8 orders last year, they were astronomical. That takes a 9, I was at Daimler, and it was at a 9 to 12-month backlog back in June of 2018. So that means that they're still putting tractors on the road that they ordered back in 2018. So that's going to continue to happen, and I don't think that should start slowing here soon.
Great. I think we've got time for one more here. This is a what if. If the trade war didn't happen, what do you think OTVI.USA would have looked like this year?
I think it would have been actually more lower earlier in the year. And I think we'd have seen a more seasonal peak in June. I think we wouldn't have seen that nasty drop in May that really took everybody off guard. We would have had a lot more, it would have been a flatter market. I think the trade war really exaggerated what was already occurring in 2018, where we had this overheated, overspending, like really excessive growth that's just not sustainable, especially without, like Anthony said, better jobs with higher wage growth. It's just not going to sustain itself. You're going to see too much disparity. And I think we'd have just seen a more calm, leveler market. We would not have seen as severe of a drop earlier in the year. And I think it's actually going to make things look worse here in the coming months.
All right. Well, everybody, it looks like that is all that we have for today. So thank you so much for tuning in. Thank you to Zach and Anthony for being here today. And if you have not yet, go ahead, get online, visit FreightWavesLive.com and get your tickets to our event that's coming up here in less than 3 weeks, actually, in Chicago. So that's fun.
Big times.
Yeah.
You got your ticket?
We've all got ours.
Yeah.
If you'd love to see these faces in person, we'd love to have you there. Again, visit FreightWavesLive.com to learn more. You can view the agenda there, see the speaker lineup, and just get ready for all that we have in store for that. So we appreciate you guys being on the line today. Take care. We'll talk to you next month.